Barring today, the rupee has been making all-time lows for the past couple of weeks after staying rock steady for 2 months between a 20 pice band, 83.05 to 83.25 per dollar. Actually, the rupee moves in the past few months has defied all logic. Logically, the rupee should depreciate when the dollar appreciates. And yet, from July 19 to September 27, the dollar appreciated by 7% from 99, the dollar index that is, to 106.2. But the rupee depreciated by just 1.3%, as you can see, from 82.10 to 83.23. Again, from September 27 to November 28, the dollar depreciated by 3.4% from 106.2 to 102.6 today. But the rupee actually depreciated. When the dollar depreciates, it should have appreciated. It actually depreciated during that period, marginally though. Likewise, traditionally, the rupee should appreciate when crude prices fall and vice versa. But note this, from September 28 to November 17th, crude prices fell 20% from $97 to $77. What did the rupee do? It was absolutely flat at about 83.23. Now, in the past 2 weeks, crude has actually appreciated by about 6.5% from $77 to almost $82. The rupee has barely depreciated, just about 10 pice. So, to come back to the latest news, why has the rupee started to depreciate, barring today, of course, to new lows after a flat quarter? Well, where is it headed from here? I have with me two experts to decode that. Neeraj Gambhir of Axis Bank and A. Prasanna, the chief economist at ISEC PD. Gentlemen, thank you very much indeed for your time. Let me start with you, Neeraj. How would you explain the rupee's depreciation? Again, not counting today, but the sudden new lows that we started seeing at a time when actually the dollar was falling. How do you explain that?
Another 2 or 3 points. One is that you're looking at a very short window of time, but if I were to extend the time frame to this calendar year, rupee has actually depreciated by roughly about 0.6 or 0.7%, whereas most of the emerging market currencies have been on the depreciation path, and some of them actually have depreciated quite significantly during this entire period. So rupee has actually been a very, very stable currency over the last, I would say, about 10, 11 months. And it has actually, on both sides of the move of dollar, I think it has kind of held on to a very narrow range. Coming back to the recent move, I think we are basically having some impact of the fact that there has been a marginal worsening of the trade deficit. And we are also seeing some kind of a weakness. I won't say weakness, but lesser sort of flows on the FDI front, which is kind of impacting on the balance of payment calculations that the market does. And that, in some senses, is also getting reflected in where the currency is at this point in time. The quarter one of this fiscal year, we had a very strong balance of payment surplus. But since then, quarter two and quarter three, it has been sort of steadily on the higher side in terms of current account deficit. Mind you, overall, the current account deficit is still expected to be less than 2%. So it is not a big concern. But compared to where we were expecting to be, at the end of first quarter, I think there has been some worsening on the trade deficit side. So I think that is also, in some senses, getting reflected in where the currency is trading today.
Okay. Well, Prasanna, on that, let me come to you. Actually, the October trade deficit was rather nasty. I remember we went with headlines. I think it's over $31 billion of only goods trade deficit, highest ever monthly deficit. Do you think that we should be prepared for more depreciation given a number like that? Huge deficit in October.
Yeah, Lata, you're right. I think the October number was a big surprise. But again, that surprise was led primarily by oil and gold. Now, oil, of course, what has possibly happened is, I think, obviously, imports have gone up in line with the rising prices and, of course, domestic demand. But possibly oil exports, there is some lag before oil exports also start going up. So maybe that is the reason for that sharp jump in oil imports relative to oil exports. Now, gold, of course, that's a different phenomenon, and it's difficult to explain, right? I mean, why? Obviously, this is festive season and marriage season and all that. We know seasonally it goes up, but still the jump was very sharp. one possible explanation is I think maybe rural incomes have been going up, and that led to a kind of explosion in gold demand. That is something I think we have to track. I guess probably last year gold demand was a bit subdued, and maybe there is a bit of a catch up happening this year. So maybe there are one or two idiosyncratic or one-off factors that should explain the October trade deficit. But more broadly, I think what we are also seeing, I think, is obviously Indian growth has been quite resilient, and I think that is also reflecting in core imports. Like even if you look at the non-oil, non-gold imports, I think they have also been reasonably strong. While obviously exports did have faced some headwinds because of a slowdown globally. So I guess this is also kind of a result of maybe Indian growth being more resilient to compared to what is happening in rest of the world.
No, actually, I was coming to that, Prasanna. When India grows faster than the world, we obviously tend to absorb more imports, and the world is absorbing less exports. In fact, to just add to the numbers you said, in October, chemical imports were up 14% over September. Iron and steel imports were up 18% over September. So it was machinery imports were up a good 10% over the previous month. So it wasn't just oil and gold. It was industrial imports as well. So once again, I'm persisting with the question: will the trade is the trade deficit a one-off, or should we be prepared for higher deficits and therefore a more depreciated rupee?
Yeah, I think we should be prepared for higher deficit compared to, say, the last few months average, right? I mean, I don't think we should be thinking that the October number is the new benchmark. Like I said, I think the gold imports played a big role, and we don't expect that to continue. So maybe there will be some reversal from the October number. But yeah, if you take a moving average of the last, prior to October, say the last 3 or 4 months, I think compared to that, we should expect a higher deficit going forward.
Okay, and therefore more depreciation.
I think if you look at most market estimates, including ours, in terms of current account also, anyway, H2 was supposed to have a higher current account deficit, obviously led by higher trade deficit, because even the services deficit, I think, services surplus seasonally goes up in the second half. So I think the higher deficit in trade deficit in second half was broadly expected, but yeah, I mean, October still came as a bit of a surprise.
Okay, well, a couple of economists who sent us reports said that they have brought their current account deficit higher. I mean, but not much, as Neeraj pointed out, from 1.6% of the GDP. I think the forecast has moved to 1.7, 1.9 in some cases, and others are just waiting to see if October is repeated in November, and then you may get higher numbers. But Neeraj, what's your range now for the rupee? Do you think we should be prepared for 84?
I think
in this fiscal.
Yeah, certainly. I think two things. One is that, first of all, given the fact that dollar has depreciated so much, and largely against the euro, in the recent past, if the FPI flows come in, there could be a little bit of catch-up appreciation on rupee, though not too much, but there could be some bit of a catch-up appreciation. But I think on a slightly longer-term horizon, say about in the next, 6 months or so, I do expect mild depreciation, very mild depreciation on rupee to continue. Largely because we are still actually looking at somewhere close to 2%, somewhere between 1.7 to 2% as the current account deficit. And we will require funding to, external flows to fund that current account deficit. And at this point in time, the FDI seems to be much lower than what we had seen in the last year. I think last year we had up till now about $22 billion of FDI flows. This year, the FDI flows have been much weaker at about $2 or $3 billion only. So it's the financing part of the deficit which I think we need to be more watchful of. And if these flows don't pick up over the next few months, then I think the rupee depreciation story could gather a little bit of more strength. Until that point in time, I think we could have some kind of a catch-up to be done with the rest of the world.
Okay. Well, Prasanna, you are sensing an 84 round the corner, primarily because, as both of you are pointing out, FDI flows are not there. FPI flows also have been intermittently negative, more negative than positive, though last couple of days have been positive.
Well, Lata, I think in your chart you showed the dollar index, crude and rupee. Two of those three, I think prices are freely determined in markets. The third one, you know about it as well as I do. So I think it's a bit of a mug's game trying to predict. it's clearly very closely controlled, right? I mean, so
It
I
is.
don't have any clear idea. The only thing I think is obviously, I think still inflation worries are there. I mean, when I look at it from that angle on headline inflation, because globally food prices are again going up, food prices are going up. So in this kind of an environment, I don't think a central bank would like to allow too much depreciation also, because then inflation expectations can also get out of hand. So purely from that management point of view, I do think, I mean, even if the pressures are there, depreciation pressures are there, I would think RBI to kind of lean against it and maybe allow only a very calibrated kind of a depreciation.
Okay. Yeah, that's what we noticed when US interest rates went all the way to 5% in April. We still were at 83.2 or 83.3. And even when those interest rates came down to 4.3, I mean, a 70 basis point fall in US yields, and Indian rupee hardly moved. So Neeraj, that point actually, I don't know if the debt flows chart that I gave is ready in the form of a chart, but we have seen very good debt flows, FPI debt flows, 14,000 crores actually in November itself. Logically, if the interest rate differential is not much, you should not see debt flows, but we have seen them. So do you therefore think that interest rate differential between US and India is no longer an issue when you're looking at the currency?
Well, I think interest rate differential has been quite low for quite some time, and I think currency has been fairly stable. So I would, kind of argue that yes, it's less of a concern right now. The fact that debt flows have started is largely in my mind, it's largely a function of the fact that we are likely to be, seeing the bigger flows to happen in the second half of next year. So in anticipation of that, there has been some active money flows which have started to come in the domestic market. It's about $5 billion so far. So I think this kind of is a prep that is happening from active money players for the eventual sort of flows that will come into the market. Estimation is about $25 to $30 billion of these flow are likely to come in into the next fiscal year, particularly in the first next fiscal year. So I think there will be some sort of preponement of that as the active players take their positions, but it is largely a function of index inclusion in my mind.
Okay. Prasanna, would you say that therefore some appreciation is around the corner? I mean, this is the first month when we are seeing a five-figure entry in debt. 14,000 crores has come in from the FPI debt segment. Do you think this is index inclusion and therefore that kind of appreciation pressure is possible?
Yeah, so clearly, I think what Neeraj is saying is right. I think it's basically anticipation of some front running of the larger index flows that's happening now. But I mean, if you look at it, I think in the first half, we had very good FPI equity flows, and now in the second half, the debt flows are picking up. But I guess the counterpoint to that is FDI is really collapsed. So again, I go back to what would be RBI strategy, right? I mean, if your strength or if your strength in capital flows is based on portfolio flows and not on FDI, then should you allow that? I mean, then should you allow a currency appreciation? So purely from a strategic point of view, also, then you shouldn't allow these flows to kind of really lead to any sharp appreciation. So from that point of view, again, I would think RBI should be intervening and absorbing these kind of flows. I think the time to allow appreciation is when you really feel there's a fundamental strength which is coming through in the BOP. It's either through slightly lower CAD or when FDI picks up. I think that's when, obviously depending on other global factors, that's when central bank would be comfortable allowing an appreciation. Purely from a strategic point of view, I'm talking about this.
Fair enough. Thank you very much, Neeraj and Prasanna, for joining us and parsing the rupee's non-moves in the last 2 quarters. Key takeaway, there will be trade deficit pressures on the rupee, but it will be countered by probably debt-related flows, index inclusion. But the Reserve Bank is likely to be the huge interventionist factor and not much reason for rupee appreciation either. The Reserve Bank normally allows an appreciation when FDI flows come in, when the grammar of investment changes, not simply because there are some portfolio flows in.
And if it helps your case, the last couple of days the FI has bought in the cash market. Tomorrow is the expiry. We'll see how that pans out as well. So that's about the currency picture. Lata, thank you so much for joining in with that insightful discussion. What we'll do is take a short break, but